Welcome back to the PlayBridge podcast. Today on the show, we are welcoming Steph Mui. Steph is the founder of PIN, Power and Numbers, a VC-backed company that enables communities of people, like people from Stanford, YC, and Coinbase, to invest in startups together. She also writes the newsletter Demystifying VC to help founders navigate the fundraising process and to teach new angels about early-stage investing. Steph was formerly a VC at NEA, where she helped invest over 150 million, and she's also a graduate of Stanford GSB. I've been following all the cool, amazing things you've been doing online, so it's awesome to finally get to meet you. I actually was listening to your feature on the Money with Katie podcast a few weeks ago, which was super epic. So that was so cool and great to finally have you on the show.
Yeah, thank you as well. I've definitely seen you more on like my TikToks, and you're my inspiration for all things short form video, which I have not done yet. So really excited to be chatting.
So to kick it off, tell us more about what PIN is and how you got started building this company.
Yeah, the long story short is PIN is essentially is a platform that does all the boring legal admin tax work associated with essentially starting a similar like VC fund for your group. Ours are a little different than traditional funds. They're called investment clubs, and I can go into it later about why they're different. But you can think of about them essentially as like democratized investment vehicles for communities of people to invest together in startups. And essentially, the long story short of how we got into it is I went to school at Stanford after doing a couple of years of VC, and my class is actually really interested in doing a class fund to invest in our classmates' startups. And it turned into, it was originally just a small side project that turned into a much bigger initiative. We ended up launching that fund in 2020 with 180 of our classmates, all investing in our classmates' startups together. And basically, a TechCrunch article came out about us. We found that a lot of other groups wanted to do the same thing. And despite kind of having figured out the playbook for a year and a half on the legal and tax side of things, it was still a very kind of painful process. And so PIN was really born out of seeing that interest from a lot of other alumni groups, first schools, but then company alum or founder groups or professional groups or communities online, all who wanted to invest in things together that they cared about. And so PIN was formed just because we believed in a better kind of product, tech, and operations solution to make this super easy for groups that want to do this in the future.
Walk us through an example from today of like a community that might be investing through PIN and how it all works.
Yeah, so we have a variety of communities. Like I mentioned, a lot of school communities and company alum, of course. The one that I'm really excited about that we launched pretty recently was one with YC. And so the cool thing about YC, it's like a group of founders all investing in each other. And so how it worked is Dave and Ryan, the founders of Orange Collective, the YC PIN group, they basically came to us and said, hey, we want to create some kind of vehicle that makes it super easy for YC founders and alum to invest in the most recent YC founders coming out of each batch. So they came to us, we did all the back end work. We had them up and running in literally less than a week, and they started inviting their cohort mates and or their batch mates and their friends from the YC community to all invest together. And it's awesome. They've closed their first one. They've made, I think, over a dozen investments at this point, and they actually just started raising their second vehicle for future YC batches as well. And so we like to think that we accelerate the timeline versus before it used to be a lot of kind of manual work where they'd have to go find their own lawyer, their own tax firm, and kind of handle all of that work. Whereas now they can kind of focus on the fun stuff, the investing, the community, while PIN kind of does all the boring stuff.
Yeah, walk us through some of those boring things that PIN does for the communities.
Yeah, I mean, that was always the bane of my existence. As anyone, anyone who knows me knows I hate doing administrative work, especially if it's repetitive administrative work. And that was kind of my biggest frustration with getting this started. Like first on the lawyer side, you have to usually outlay a pretty large sum of money to kind of get a fund up and going. We were very fortunate to have very great partners with Fenwick very early, who kind of was our lawyer for the first one that we set up. But typically it's very expensive kind of to even do that. And then there's like a long process of iterations and back and forth to kind of form that vehicle together. And then I'd say on the admin and tax side, that's actually where the repetition comes in. There everything from, setting up LLCs to actually house the fund all the way to remembering deadlines every year and they come up to pay Delaware taxes and other things. There's issuing kind of fund level and individual K1s for everyone, and basically a lot of other kind of one-offs that come up involving deadlines, fees, or other things that I frankly didn't even know existed and needed to be done before actually doing it myself. And because there's not one kind of cohesive place to know about all of this, it was kind of it felt like juggling a lot of different things and chasing a lot of deadlines versus being very proactive or frankly being able to outsource all of that. So that's just some of the examples of like the back end work that we do to support these vehicles.
And you mentioned that you guys are set up like as investment clubs. What exactly does that mean? Like, who can be a part of these communities? Do you have to be accredited?
Yeah, so that's a great point, actually, and one of our main differentiators. Speaking about how we got started, part of the reason why we started looking for different options while I was at GSB to do this for our class was because none of the existing solutions really fit what we wanted to do. And frankly, one of the big ones was being able to include both accredited and unaccredited investors, since over 60% of our class wasn't accredited. And so the cool thing about PIN, you do not have to be accredited in order to participate in a vehicle, which I think actually is really compelling for a lot of groups because formerly it used to be just kind of inclusive of the top 10% of people who are accredited versus now it's kind of a full community initiative for a lot of communities out there. The main difference I'd say between an investment club and a fund is that they operate very similarly in the sense that money is pooled together, the group collectively invests in things. But instead of a traditional fund where there's this, an LP GP structure, meaning if you invest in a fund, you are not involved in the investment decision making process. Sometimes you may hear about them, sometimes you may not, but it's usually way after the fact, after a GP on your behalf makes that investment. Investment clubs, our investment clubs are set up to be much more democratized, meaning whenever a company comes to an investment club to receive an investment, it's automatically put up to a vote. And so every single member in that group has a chance to actually vote on that investment and say, yes, I want to invest, or no, I don't want to invest. And that kind of active participation is what makes the experience of being in an investment club different than being a fund. And then there are lots of other implications beyond that. Just like, for example, I think being an LP in a fund, don't get me wrong, is really great. But I think it's less kind of uh, interactive and less engaging than being a member of an investment club where you're not only voting on investments, but you're chatting with and discussing investment opportunities or partnership opportunities with other members in the group. You are learning about what your former classmates or other alum from a company, for example, or other founder friends are building or up to in their updates. We also have some fun features that enable people to help other portfolio company founders and receive points or sometimes even monetary rewards in a fun gamified way. And so I'd say PIN is a much more kind of like social consumer first version of like a traditional venture capital vehicle.
Hmm. I imagine also having these almost like little operating communities for Penn like really helps you win the deals and like get allocation into some of these startups. How have you seen that play out?
Yeah, it's a nuance that I really appreciate you bringing up because I don't think people realize how powerful this mechanism really is, and frankly speaks to our name, power in numbers. Especially now being a founder, I can empathize with this a lot. There are just so many things that you need help with on a daily basis that come up. Everything from super small, hey, we're launching a new feature and would love some social media love and likes and retweets and things like that, all the way to hey, we're fundraising for our next round and I'd really appreciate a crowdsource from the community of any investor interest you think would be really great here. And so we've seen kind of the whole plethora of asks. And part of the inspiration behind PIN was seeing how it really played out for our first ever vehicle with my grad school class. We had this thing called Blast, which essentially was just this kind of unmonitored, unfiltered list host that people could fill out information and send out emails asking for help on a variety of things. And it was really kind of a unmonitored thing in the sense that people would participate and kind of just help because they were excited about helping classmates. There was no kind of gamification or rewards or anything built into that. But we found that that was even strengthened by forming this investment vehicle around it, where people were always willing to help anyway, but there was almost like a layer of seriousness that was put onto it once there was formality, meaning like I was literally invested in you, and therefore I'm like quite literally incentivized to help. And we found that the engagement increased even more with that. And so we've built our entire product not only in terms of forming these formal vehicles, but also building an awesome product that people can engage with in a really easy way that makes it easy and fun for them to help as well with all these little tasks I mentioned.
Yeah, super smart. So you mentioned a good portion of your Stanford class was not accredited and they were interested in investing into the space. Who do you, in your opinion, like who do you think should be angel investing, and like, why do you think it's important to open up access to these types of investments?
Yeah, I mean, I'll be honest, a big doubt that I had for a long time, and frankly, why we didn't pursue PIN as a company until actually many years after the fact. We started this back in 2018, 2019, launched it in 2020, and then there was at least a couple of years before we actually pulled the trigger to create PIN. And I think it was originally because of this question, which was, does it make sense out of, a certain type of community, which in our case was like Stanford, close to SF, community, which I, totally admit has a lot of privileges in itself. And so I had questions about whether it made sense for groups outside of that to engage in this way, especially since angel investing, as you know, too, being in this world is super, super, super risky. And I think a couple of things really changed my mind. One was frankly seeing the incoming demand, like groups that I never would have even expected to be interested in investing were coming to us, digging up this TechCrunch article from years ago, asking for help of doing the same thing and hearing about their stories and what they wanted to invest in and why. It was very clear to me that there's, um, a shift in the world and how people are thinking about investing. People want to align their money with their values, and they're thinking about investments more of like learning opportunities and ways to actually engage and make a difference versus just putting in a passive check into a stock or a mutual fund and just letting it sit. And so that was one compelling moment. And then the second I'd say is kind of learning more about the macro environment, particularly around startup and private investments and how they've created a ton of value over the last 10 to 15 years and how it's actually outpaced the value creation created by public markets. And there's a lot of reasons for that. Companies going public later is a big one of that. And because VC and private money has increased significantly and therefore has pushed those deadlines later and later. But the essential, result of that is that everyday retail investors who have access only to stocks are getting into companies way later than they used to be able to, meaning that they're missing out on a lot of the value creation that's created or created early in the days of startup creation. And that was really frustrating to me to see that obviously such a big asset class is literally gatekept from so many folks. And so I think the solution is not just like opening up angel investing to anyone and allowing kind of unfiltered investing in any sort of company. But I think providing more education so that people can actually evaluate angel investments reasonably and actually decide for themselves how much they want to allocate of their own portfolio into this. And then, like I mentioned, there are lots of other non-financial components that I think are just generally really beneficial for folks. But our goal is to provide both the mechanism, but also the education for eventually everyone. But starting first with kind of tech and the tech tangential circles outside of that and expanding from there.
To your point, it can be very intimidating to break into this space and like make your first angel investment. Can you share an example of one of your first investments and how you kind of became comfortable with the level of risk and how you thought about making that first investment?
Yeah, I mean, I totally empathize with that. And I feel exceptionally lucky because I made my first angel investment while I was working in VC. And so I had the like not only was I learning how to evaluate it, but I also had the kind of senior partners and people I was working with at the firm to really guide me doing a thing that I had never done before. And so I definitely empathize with that because it is really intimidating, even if or even now, frankly, doing it independently in some situations. So my first ever angel investment was a company called Wheelhouse. They're also formerly known as Lyric, and it's very different than what I normally would invest in and other future investments that I've made. But they're actually like a RevOps and financial intelligence platform for mostly like short-term rental owners. And so they help, Airbnb or VRBO or other short-term rental owners or professional management companies basically maximize their own revenue by pricing units intelligently. And it's super fascinating software business. They also had a company that was doing their own short-term rentals using this data as well. And the reason why I made it is just because I frankly loved the founder. I got to know him in a really great way through the diligence process that NEA, the firm I was at previously, was doing. And I built up a lot of conviction in the space. And frankly, we had diligenced so many companies, both in that space and out of that space, for months before that. And none of them really kind of got me as excited as this one. Everything from, doing the diligence firsthand and getting to see those numbers and data myself, but also getting to see, the founder work and grow over time, which I think, frankly, a lot of investing really is just about conviction in the founding team really compelled me to make the investment. And frankly, it was one of the best things I ever did. It was 5+ years ago now. It was a long time ago. But I feel like I learned so much just being part of that journey in a very, very small way, being able to add value in very small ways and getting to know more about the space and learning from a grade A operator, I think is, again, outside the financial component, just a huge benefit that I've really gained a lot of confidence from as a founder now myself.
For people who might not be in VC and are looking to start getting invested, what are some of like the biggest tips you share maybe in your newsletter about like things you should be looking for in an investment?
Yeah, the number one thing I always say is that, especially if people are doing this for the first time, to only invest in things that you understand. For example, if you work in real estate, for example, and you understand real estate really well, say there are startups in real estate, say your vertical of real estate that you think would be really compelling, like I would almost focus on that as a way to kind of break into angel investing to make your first investments. Like, what specialized information or personal conviction do you have or can build based on your own experiences to get excited about a company? And I think I've seen a lot of people, myself included, kind of give into FOMO and other things, especially when companies have all these amazing brand names on their cap table or seem like they're doing really well on the surface, but are in areas that you don't understand. And I definitely saw this with myself with crypto. I didn't end up actually making any of these investments, but so many of them were passing my plate, and I was constantly feeling conflicted about whether I should bite the bullet and invest, despite not really understanding the fundamentals because it's not my world. Um, and I, every time that has happened, I feel relieved whenever I realize that it was probably the right decision for me to kind of stick to what I know, which is frankly like consumer and fintech and SaaS. And I think that's okay. And so that's just the number one thing I'd say. Like, you can use a lot of signs, whether it's like other investors or the strength of the founding team, other things as proxies for building conviction. But especially in the beginning, I would kind of stick to ones where they're in an industry that you personally have experience with.
That's great advice. I'd love to shift the conversation a little bit to hear more about your career journey. So I know before the MBA, you were in venture and you also have a background in investment banking. So walk us through why you decided to pursue the MBA, and what your like goals were for going into GSB.
Yeah, I'll be honest, it was not the easiest decision. Like, from a really silly point of view, I guess. The long story short is that I had applied in college. Actually, I knew at that point during senior year of college that I was going to do investment banking, and I had this whole roadmap in my head of investment banking and then private equity, and then of course I'd go to business school, and then I'd go back to private equity, just because that's the path that all investment bankers or a lot of investment bankers do. And I didn't really think much beyond that, and so in my head at the time, it was just kind of fulfilling this plan that I had had and was going to follow. And then I think, frankly, I didn't end up going to private equity. I ended up going to work at venture capital at NEA. And I really, really liked it. And I think the thing that really surprised me is that, not only did I see a world outside of PE, but working in VC actually made me more excited about doing something that wasn't even in finance at all, right? Like, I found myself gravitating towards any experience that I had, like working with founders in a more meaningful way, like sourcing and diligence and all that stuff is super fun. But frankly, I loved kind of spending time with founders or with portfolio companies. That's the stuff that really kind of got me excited. And so, frankly, my 2 years at NEA was running up, and my GSB years were about to start, and I had a really, long, I'd say, existential crisis to figure out whether I wanted to go or not, just because I was conflicted between wanting to stay in venture versus starting my own company right away, or maybe going to business school, but it was really expensive. And I questioned the value add, and Silicon Valley in general also is very negative on MBAs. And so I just wasn't sure if I was doing it for the right reasons or just because it was a decision I had made for myself many years ago. And I ultimately ended up deciding to go because I felt like it was almost like a risk averse way, or maybe that's not the right way of phrasing it, but almost a more safe way of experimenting with starting a company. And in some ways it was right, in the sense that I think I freaked out when I was at NEA about the idea of going from having a salary to having very little salary as a startup founder. But when you go to an MBA program and you're making no money and you're spending a ton of money to be there, anything else that you do and making even a nominal bit more money than that feels safe. And so I feel like in some ways, just biting the bullet to leave a paying job to then exploring and having essentially like no rules guidelining or no rules to follow was like a really big step. And so I'm really happy that I went in that regard. I wouldn't say it's like the most practical way to start a company, so I don't necessarily recommend it to everyone. But it was the path that I took, and obviously has influenced me greatly today, even in regards to PIN.
Completely agree. And I had like very similar thought processes. I recently graduated from Anderson at UCLA
Yeah,
with my MBA
cool.
and share a lot of those same pros and cons that it's tough because everyone's always like, is the MBA worth it? And it's so specific to your own journey and your goals, but very useful to
Totally.
hear everyone's different insight into why they ultimately decided to go or to not go. And then so when you were at Stanford, were there like great resources for you? Like, did you know you wanted to build Penn, or did you just go in being like, I want to build something entrepreneurial and I'm going to figure it out while I'm at school?
Yeah, I'd say it was definitely the latter. And funnily enough, like I mentioned earlier, like my side project ultimately was the reason why I created PIN. But in between even launching the side project in our class fund and starting PIN as a company, I'd worked on a ton of stuff in between then, everything ranging from the manufacturing space to travel to fitness to, a ton of other things. And so it definitely was not a linear journey, that's for sure. And I'd say in terms of resources, it was yeah, I'd say it's really helpful. I mean, I think most people, and I'm curious about your experience too in your MBA program, but I felt like the MBA program was helpful, but it was really kind of the people and just the freedom and almost lack of structure that I think enabled me to like build the confidence and resources and knowledge to do what I'm doing rather than say a formal class or, something inherent to the MBA program.
Totally agree. I actually think some of the entrepreneurship classes at UCLA maybe like slowed me down or distracted me a little bit.
Yeah,
So I think really like the time to just like think and try different things, and then also definitely like the people and having the resources from a UCLA or a Stanford or like a great entrepreneurial program were very invaluable to me at least.
100%.
Um, and then after school, did you decide I'm going full time on Penn, like right after graduation, or was there ever any like, well, maybe I should go recruit into a job, or what was your thinking, and where were you at graduation?
Yeah, I would say that I never really wavered in my thinking of, wanting to be a founder. I was worried definitely that I wouldn't be able to be one in some ways because I think especially after being in an MBA program and paying a ton of
Yes.
money to be in school, which you can relate to. Uh, Frankly, I was like, oh man, I have student loans to pay off, and I should probably start making money somehow. And so I had kind of given myself a deadline of graduation to either have like a very strong concept figured out and essentially something up and running and an MVP that I really believed in. And ideally, at least a way to pay myself, meaning we had raised at least like a pre-seed round or something. And so I was pretty focused on that. Like I said, the journey to get there though was super nonlinear. I was working on so many different things. Had tested out 3 different co-founders during school. Unfortunately, none of that worked out, all due to amicable reasons, but it was definitely very kind of chaotic. And then I'd say at the very end, kind of coincidentally around COVID, been working on a travel idea actually. We literally just launched it. And then less than a week later, COVID hit, and that obviously went completely to zero. And so, um, there's kind of more details in there from there. But we were fortunate enough to kind of meet an investor who really believed in us and gave us a small pre-seed check early. And that's kind of really what bridged us from having to pivot that idea into ultimately iterating many more times after that and then ultimately getting to PIN. But like I said, it was,
Wow.
yeah, super nonlinear. And I'd say, we kind of met that deadline that I'd set for myself by, a very short margin. Yeah.
That's an incredible pivot. What was the, can you share more about the travel startup and who was on the team, and are they still on the, like, do you still have the same co-founder from that working on Penn?
No, so actually I'm a solo founder now, and that's not I wouldn't say necessarily due to choice, but it has worked out well, and I'm very fortunate now to have a really great team around us at Pin. But the quick story around the travel startup thing was, I've been working on that for I'd say 6 to 8 months or so with one of my best friends from college who, we had plans for kind of working together full time after I graduated, and he would kind of leave his job. And it was a combination of a lot of things. But I think the TLDR is that we launched our product. He was getting ready to quit his job. We had a term sheet in parallel coming our way. And then COVID hit. And I think it spooked both the investor and also him, frankly, which I totally understand, in the sense that, he was really worried about kind of stability going forward, and obviously just the viability of our idea that we've been working on for many months together and how it'd fare in this kind of environment. And in some ways, he was totally right. I was convinced that, COVID was going to be over in like a month and we'd be able to go back to what we were doing. Clearly, that was not true at all. But because of that, he ended up dropping out. I actually ended up being a solo founder at that point going forward, tested out a few more relationships, things like that. But that's what kind of led us to this very nonlinear pivot. And we worked out, 15 other ideas since then, most of which I was doing by myself while also looking for another co-founder on the side. And yeah, there's lots more kind of detail in there. But the high level is like, things are not as linear as they seem on paper, I think. Like when people usually see PIN, it seems like a lot of people think that I went straight from school to doing that right away. And that is certainly not the case. And so if anything, I hope it gives people inspiration to know that like things
Yes.
will work itself out eventually. Yeah.
I love hearing a nonlinear path because I have definitely had one of those. So I very much appreciate a nonlinear path.
Mhm.
Since you touched a little bit on fundraising and since you've been on the investor and now the founder side, I'd love if you could talk like a little bit more about both your pre-seed and now your seed round that you've raised, like who you raised from, any strategies you can share for other founders who might be listening.
Yeah. Man, I don't even know where to begin. I'd say for fundraising, despite having had the VC experience before, it's actually frankly my least favorite thing, which is maybe something I shouldn't say since it's a big part of the role of a founder. But for me, what I have found is, I guess, two things have made my processes a lot better that I recommend to folks too that I talk to, which is one, feeling ready. And there's a lot of things that go into that. But I think a lot of things that I see are, people are fundraising way too early or doing it in a way that's not strategic. Meaning, I think one, like building conviction yourself, that's kind of baseline. Like you should go out with a lot of conviction in your idea, having fully fleshed out something, number one. But two is, whatever KPIs that your business is going to be evaluated on, you should be putting yourself in the best position to fundraise based on those KPIs. So just to give a more practical example, when I was working on the fitness startup, I knew immediately that retention was everyone, every investor, including every VC and angel investors' top concern because fitness is historically a very finicky industry. And so for me, I basically had designed an MVP and measured retention very critically. And once we kind of iterated to a model where the retention was really, really good, that was kind of when I pulled the trigger to fundraise, right? Because we kind of unlocked that thing that I knew a lot of investors would nitpick at. And had we done it too soon or much later, for example, those metrics might not have been as strong as they were at the time of the fundraise. That's kind of like one very practical example. And then secondly, I think it's about running a process. I think I see, frankly, too many founders do it in a very casual way, especially when you're trying to raise money on purpose. I'm not talking about kind of like building relationships over time for future rounds, but especially if it's your first round, your pre-seed or your seed, I'd be super intentional about scheduling meetings and actually running a process over several weeks, meaning, reaching out to people, scheduling meetings out like 3 to 4 weeks in advance, even though that kind of sounds ridiculous. Putting enough density of meetings all in the same week so that second meetings and third meetings and partner meetings all come at the same time. Treating it kind of like a sales funnel, if you will, rather than just kind of haphazard scheduling on a calendar randomly, I think is really kind of the best way to do it. And so those are always my two biggest pieces of advice to folks.
And I imagine you write a lot about this in your newsletter as well. So we'll make sure to
A
link
lot.
it for other founders listening that want to learn more. And since we are on the topic of fundraising, I'm asking all investors this season to debunk a venture capital or startup concept of their choice. So, what term would you like to debunk, and can you explain it for us?
Yeah. I'm curious, has the concept of dilution been explained at all?
It has not.
Okay, great. I'll take that one then. Just because I think it's something that a lot of founders don't understand as well as they should, in my opinion. And I think it's something that I only understand because of my venture experience. And basically, the whole idea of dilution is essentially that every time that you raise more money for your startup, obviously you're giving up more and more percentage of your startup. And I think a common mistake that I see founders make is that, especially if you're raising on safes, for example, where there isn't a priced round where there's a guaranteed percentage that you're giving away, that calculation gets lost for a lot of folks. And so people might raise a ton of money on safes at different valuation caps or different discounts or whatever it is, not realizing exactly how much money they're giving away. And then their price round comes, all of those safes convert for the first time, meaning that those percentage ownership amounts are locked in and kind of put onto a formal cap table for the first time. And there's a kind of a huge shock at that point, not only because it's really diluted to the founder, but frankly also I think it's a thing that more VCs and professional investors are diligencing, because they also want to be assured that the founder has enough equity in the company that they're going to be incentivized to stay around for a really long time and do what's best for the company. Whereas if you're too diluted by a certain point, say you only own 20% of a company by the time you're raising your Series A, for example, that's like a really intimidating thing to a lot of investors because they're not sure if that 20% is going to be as much as the founder would need to kind of stay motivated for a 10-year journey from that point. So I'd say that's just something that I would double click on and advise founders to be more careful of when they think about raising money, especially on what valuation and from who and all that kind of stuff.
And as we start to wrap things up, can you share a female founder, investor, or leader who inspires you and a little bit about why?
Yeah. So Aileen Lee and Amanda Robson, who works with Aileen at Cowboy, are two that come to mind immediately. She's more well known as Robbie, but her name's Amanda Robson, and they work together at Cowboy, like I mentioned. And Amanda's more of a peer, but someone I really look up to, even though she's the same age. And then Aileen, obviously, is just iconic for a lot of reasons. But the reasons why I look up to them a lot is because I think they are not afraid to speak up for people who aren't as represented, especially in the VC and tech world. Aileen obviously is well known for starting All Raise. Robbie is not only a really big volunteer and advocate for All Raise, but she's also started her own group called Modern Angels and does a lot of kind of other work to support female, non-binary, or other minority founders or VC investors, et cetera. And is truly someone who I think like walks the walk rather than just talks the talk. And so I highly recommend people to check out their work and follow them, Twitter, wherever you can kind of, follow them.
Amazing. Thank you for both shout outs. And I will make sure to include their links in here as well. And then finally, where can people connect with you and where can people find Penn?
Yeah, I'd say Twitter or now X, whatever you call it, is my best bet. For me, it's Steph Mui, spelled STEPHMUI. And then PIN, our URL is really annoying, admittedly, but it's getpin.xyz. And we're also on Twitter as well, and you can find it in my Twitter bio.
Amazing. Well, thank you so much for being here today. It was so awesome to finally meet you and learn a little bit more about your journey and what you guys are building at Penn.
You as well. Thank you.